Appleman Properties. Today we're joined with Charles Carillo. Charles is a partner at Harborside Partners and has invested in real estate since 2006 with over $200 million in assets and hosts the Global Investors Podcast. Charles, we're excited to have you on the show today. If you could let the listeners know a little bit more about yourself.
Yeah, thank you so much for having me on today, Josh. As you said, I started my real estate investing career in 2006. I'm originally brought up in a real estate investing family. My dad has been a multifamily investor since 1984. So I grew up in the business. My dad self-managed a lot of properties. He owned a lot of like D-class properties and C-minus properties, not really great properties. They're tough areas. He self-managed them. He like put together a team. And he really got that with a partner to almost like 100 units over 15 years, then started selling them off. And when I got out of college, I started buying properties. He kind of pushed me to buy a property, and I bought now we call it house hacking, but back then it was just buying a 3-family property, living in one of them, renting out the other two. And that's what got me started. It was the end of '06, so a interesting time to be buying, and not the best, but it was something that it did some renovations to it, got it fully rented, and was able to a couple of years later do another 3-family, and then I moved into commercial in end of '09. I bought my first commercial property, which was a mixed use property. So it was like 4 units on the bottom, or actually it was office on the bottom, and then 4 units above it, rental apartments, and then started growing from there, and moving down to Florida in 2012, and started dealing with getting into larger multifamily properties, and then we started getting involved with syndications in 2018.
That's awesome. And growing up in the around the industry, you get to hear certain things that other people don't get to hear, and kind of set your mind. It kind of like reminds me of what my kids now hear from my conversations. So it's very cool in that atmosphere. Um, what uh, what was the pivotal moment to move down to Florida and then start doing larger deals?
So it was just something that when I got out of college in '06, I already had my parents had already kind of made it known years earlier that they're going to be retiring down there, and Florida's being is a lot more of a business friendly state than Connecticut was. So I kind of knew that that was kind of in my path to make it down there, and it was just one of the things is that there wasn't much growth in the area that we were in central Connecticut, when in some of the cities that we were in that we were investing into. And so getting down to Florida, there was a lot more growth happening, a lot more, it was much more tenant friendly, as you know, more difficult being a landlord in the Northeast. And I mean, these are all just perks of going down there and buying bigger deals and getting involved with it. Why we got into bigger deals was just the ability to scale, and it was just something that when you're buying smaller multifamily, and I was self-managing all of our properties, '06 to 2012, all of my properties. I had some with my brother as well, and it was a lot of work. I mean, they were all very close to each other, but it was a lot of work to self-manage them. And so getting into larger properties, it's easier to put in management to handle those properties. I had a very good manager because I sold that whole portfolio in 2022 of our Connecticut properties. And when we did that, it was something that we had a good manager for like 10 years on on those properties. But it's hard to find good management, especially when you have properties that are, small properties that are, not located on the same parcel. You know what I mean?
Yeah.
So that makes it harder. It makes it harder to manage. It makes you almost have to get pushed into doing your own management company or paying a lot of money and fees for it. So we were lucky not having to do that. And then getting into larger properties is when you're able to really put on-site management, which is key. And that's what I've like found out is key to investing at all in real estate. Is once you get that on-site management, you take off like a lot of burden on you, because there's a lot of issues you're dealing with even if you have a property manager. All the different traveling between properties and getting this taken care of, and that there's a lot of wasted time that you're paying for as a owner. And when you have the on-site management, it's like, okay, all of these menial tasks are now taken care of on site, right? So toilet just needs to be, plunged or snaked or whatever it is that's happening. Drains need to be snaked. Any of this stuff, minor stuff, can all be done on site, right? And it doesn't take me having to pay for a contractor to come out to do it. It doesn't take this person 2 hours to get there. And so these small things being taken care of is one less thing that you have to deal with. And now you're just, you're focusing more on being able to turn units faster, get better tenants in the units, and really run it like a business. It's much easier too.
Yeah, you hit on almost so many different keys there. The scattered sites,
Hmm.
managing those is of course more expensive, and finding the quality property manager is not going to fee the property to death and overrun it with expenses is almost impossible. So you're forced into managing those properties,
Yeah.
and then ultimately that inhibits your growth because you're stuck in the weeds, and
Yeah.
you got it's hard to scale. That's huge. And now you're doing much larger deals and syndicating them. Is that correct?
Yes. So we've been syndicating, working with syndication since 2018, and we've really moved up that minimum on our unit base to about 100 units. We go a little lower than that depending on the specific deal, but really we want to be in that area where we can have two full-time people on the property and have it make sense. You can always put two people on the property, but sometimes it doesn't make sense.
Yeah, your leasing manager, property manager, and then your maintenance
Yep.
tech, and just make sure things are kept well kept. Um, what was the transition from owning your own, using your own capital, deploying your own capital, and then ultimately trying to keep the cup filled, and then find a bigger deal? What was what enabled you to get to that point? Was it a mastermind? Was it getting in different circles?
I think it was I learned about syndication initially in 2008, real estate syndication. And my dad had invested in syndications before, not real estate, but other businesses. And back in like the 80s and 90s. And some did well, some were oil and gas, some did well and some didn't. But so I had an idea of what it was and I started learning more about it at that time. But it was something I never wanted to do. And I think it was like 2017 or so, like I was speaking to a mentor and it was just kind of the roadblock there. And it's like, listen, if you do want to like do this as full time, because right now you have your own properties, you have a little portfolio, it's making money. If you want to go and actually make this like a real business, I mean, you're gonna have to start taking money from outside investors. And so that was really what happened and kind of ignited it where it's like, okay, there's no other way around this. It has to be done. And so something I always want to avoid, asking people for money, and now I'm doing it. So
Yeah, that is one of the biggest obstacles because you have the I want it for myself mentality, and there's nothing wrong with that at all. But if you're going into real estate as a full time business, you have to keep it balanced because you have to stay liquid, highly liquid, to even qualify to even get into bigger deals. I mean, the banks want to see your balance sheet and cash on hand, and it's hard to keep deploying cash when you also want to grow because
yeah,
you're forced into that as well. And at the same time, you're able to help people invest in real estate, and essentially they can go drive, see, and feel and touch it, and it's much different than other investments. I was at a conference the other night, and the investments were like biotech companies and
mhm,
um, companies that have trademarks on certain technologies. So they're seeking investments, but it's like what if scenarios. If
yeah.
this works out, then that versus real estate, it's there no matter what. So it's just different. What makes real estate cash flowing real estate so powerful?
The key with cash flow in real estate, and when people ask me about how we made it through like '07, '08, '09, and it was really '08, '09 was really, I guess, 2010 too. These were really the tough years with it. And the main thing was that we had cash flowing assets that we had owned and we had long term debt on them. And so it was something that when you have assets, see, really, the value of real estate only matters when you're buying, you're selling, or you're refinancing. During the other parts of ownership, it doesn't really matter what the value of your property is. So it's one of those things that if you purchase a property that's already cash flowing, right? So you're covering all your expenses, you're covering your debt service, you're making money every month. And if you go through and you have long term debt on this 5+ years, and you go through any type of time where lending has kind of tightened up, which we kind of like what we've seen over the last year or so, but it went through a major way back in '08, '09. Everybody tells about the deals in those times, like coming out in '09 and 2010, but people don't really tell you about the lending environment being
Yeah,
nothing. It was like I would renovate properties, small commercial properties, bring them to banks, and I would literally be offered 10 to 15% loan to cost of what my cost was on doing the whole thing. nothing about the loan to value. They didn't care that I had thousands of people, thousands of dollars a month coming in from people paying from like good tenants, right, with credit scores and stuff. So it's like, it's one of those things that you don't really hear too much about, is that when the lending goes away, that's when some of the deals start coming up, because certain deals are becoming more difficult to finance. But the cash flowing part of it allows you the ability to, if you're going through a tough time, to really, in lack of better words, to kick that can down the road a little bit and be able to, buys you a little time. You can make some money on it. You can pay down your debt. And every time you're paying down your debt, it puts you in a safer and safer position. So you can come out of these pullbacks, these recessions, and you're able to be ahead of the ball a little bit because you have a good property. You know what I mean? They're not, if you're making
Yeah.
payments, they're not coming back bother you. You know what I mean?
Yeah.
So.
You're positioned a little bit different now than you were in '08, clearly. So how have you positioned yourself to what if there are opportunities coming up?
So, it was when we deal with now, it's really, you're in your syndicating properties, you have the deals, and then you also have to have the money on the other hand. And
Yeah.
then also you have to obviously execute on those. But the main thing that you're doing to do more deals, is really the finding the deals and finding the money. And in the times when deals really come out, it's really when the money becomes tougher, as anybody that's raising money in this time knows. So speaking with investors, and really lining up that we're staying to our goals. We haven't bought anything this year in 2023. We purchased at the end of 2022 was our last deal. We bought two last year in 2022, but we've sold about 6 properties in the last year and a half. So it's really just finding deals and finding properties and just letting our investor base know, this is what we're sticking to. Nothing's really changed. When we find deals, this is what we'll bring to you. This is what we're looking for. Last deals we've done during this higher interest rate period, this is what it looked like. And you can let people know and just really and I think, you have investors that you speak to, more sophisticated, are they like that more, that you're being a little pickier with what
Yeah.
you're doing. And I like that too. If I'm investing, I don't want to see just somebody, no matter what's going on in the market, just, hey, there's a deal every quarter or there's a deal every month coming. That makes me a little uneasy because I want someone that's gone through and like, okay, we've gone through all these deals. Here it is. And this is what it is. And it's going to be a lot more work to get deals like that. But, we bought a deal in Dallas at the end of 2022, and literally, off just the top of my head math, I mean, you're probably talking 10-15% less we paid for that property than it would have been, 2 years, a year and a half before. So,
Oh, yeah.
when you're getting a discount like that, maybe it's still going down now. It's cash flowing. We're paying distributions to investors, but it doesn't matter because that's going to be growing and we get a discount on it from before. And that's something that now we're working with it and we can bring that to the next level and possibly refinance it down the road or sell it.
Yeah. Yeah. And I mean, regardless, you still always make your money on the buy. I mean,
Yeah.
that's extremely important. A lot of people are saying that now, as far as buying based on performance and what it can do.
Hmm.
We're extremely conservative on our underwriting as far as even rent growth. 1% to 0% in the next 3 years, just because if there isn't rent growth, if things plateau off and possibly dip, we're accounting for it. And if that's not the case, great. Then it works either way. But
Yeah.
just we're trying to kill the deals in any way, and if they work after we try to kill them, then it's a deal. What about debt right now? What are you say a great deal pops up? What are you seeing as an option?
So for debt that we're seeing on some of our properties, like the one we bought last year, we're somewhere, we have floating with a cap on that, and it was at the end of 2022. So it really is when it kind of when we were Fed funds was at like 4%. So it was pretty high up there, and now we're about a percent and a third or something higher than that. But it was something that we do it with rate caps on it still. And I mean, right now we're seeing possibly a slowdown in the increase on these, but we're going to refinance 2 deals next year, and we're in good positions to do it. So you can work with variable, floating rate debt if you kind of know what you're doing, right? And
Yeah.
if you're buying properties that warrant that. The problem is when you're overpaying for properties that don't have much meat on the bone, that's when you're getting into issues where you're unable to. You only raise the rent so high in certain neighborhoods, and a lot of deals that we've heard probably that's gone viral on social that have been foreclosed upon. uh, one of the trends I see in a lot of those is that they're not in great areas.
Yeah.
And one thing my dad really instilled on me, which I've really taken another level, is that we haven't bought any C class properties in probably 3 years or so. We got out of the majority of them, or we got out of all of them. Our last one a few months back, someone purchased one of our last ones in Tampa, and it's now focusing on just better properties. And when I found with better properties is it's easier when dealing with investors, and because it's less volatile.
Yeah.
And the other thing too is that when you're going through rocky times, there's always buyers for good properties. You start getting into poor quality properties, less than ideal areas, and those are going to be the ones where you're not going to have as many buyers, or they're paying you pennies on the dollar. You know what I mean?
Yeah.
You'll find people that will pay you, obviously not what it was maybe a couple of years before if you're going through a recession, but they're going to give you a strong offer on a property that's in a good area if it's a solid property. You just have to know when you're buying that property that you have to get comfortable. And I hate this term, but it's really get comfortable paying a little bit more. You know what I mean?
Yeah.
For better quality. And it's always something I avoided when I was younger. But I think as I matured in my real estate investing, it's buying better properties, better areas, and it makes it a lot easier everywhere.
Yeah, well, and it's hard to consider like that 1996 vintage versus the 1960 vintage. You've
Mhm.
got one at a say a $50 to $60 or $1,000 per unit basis, and the other one's at 80 to 90 to 110, more than that. But you're buying time as well.
Um,
One's degrading literally, and the other one's just maturing.
yeah.
Um, it's
I
hard
was
to
speaking
find
to
those.
Yeah, I was speaking to a family office, not to cut you off, like a couple years ago, and they were showing me their kind of their research on how properties getting older have historically had worse collections. And it makes perfect sense, but you never put two and two together. But it's something that when you look at those graphs of how they do it, and they're just like telling you exactly, you know what I mean? Exactly like where it's going down. It kind of pushes you into buying better properties. Like, they have it and they're like, and that's something for us. It's like, okay, it has to be like 1985 or newer, and we won't go anything lower than that for obvious reasons with how the bones are built in the property, but also for that historical trend of as properties get older, usually less than ideal tenants are living there that might not be credit tenants.
Yeah. Yeah, and that's like what you and at the time of possibly what we're going to be seeing is every class kind of goes down a class, asset class, and then what's left is it gets tough. Flat
Yeah.
tires can make or break the month. Um, so, what have you seen with your experience? What have you seen the biggest mistakes that real estate investors are making or have made?
So new real estate investors, it's a few things that I kind of tell them. When you're buying real estate, if you really want to minimize your risk, multifamily properties, it's really, buying with long-term debt. Buy something that's a minimal, if any, renovation. I mean, there's, just in your first deals, you don't want to get into major renovations. And I did that on my first deal, not my second one, but it was just something it was a ton of work. I totally underestimated everything. You know what I mean? How much time, the cost, the whole nine yards, and finally got people, everything rented, and it was, we were cash flowing. But it's just you don't want to get into that position. So it's really long term debt. People not doing that, people getting into major renovations, and people buying in not great areas. Buy better properties in better areas. It's going to be a little bit more pain when you write that check, but it's something that you're going to get better tenants. You're going to get tenants that stay there longer. And also it's just going to be, it's better all around, but it might
Yeah,
look a bit more expensive when you're working out those numbers and everything like that. But you have to look forward, and those are going to be the ones that appreciate more too. And I know we don't want to buy an appreciation, but it is something that everybody should be looking for too. You know what I mean?
yeah, that's a bonus.
Yeah, yeah. You're buying lower quality property. They're not going to appreciate as much as a better property. That's just
Yeah.
what it is. Any market.
Yeah, it's just like seeing the performer rents, and then you're like, yeah, those are performer rents in a different type of market because that area, there's
Yeah.
no way it's happening. And I've seen those deals, and it looks great on paper, but realistically, it's a heavier lift, and then you've got to re-tenant the entire complex, and it can be grueling for sure. Um, so how to invest in the U.S. Real estate market to foreign investors? How would you foreign investors coming in? How would you guide them into the process?
Yeah, so when we work a lot with foreign investors, and my first LPs were not in the US, they were business partners I had that lived in Europe. And it really, I mean, I'm not an attorney, I'm not a CPA, but what really happens is people reach out to us if they're foreign based, and we can kind of walk them through the process. We put them together. We have a list of different professionals that focus on working with foreign investors, and then those when they're talking to one of those professionals, they can really figure out exactly what's going to be the best structure. Now, typically, what happens is structure that we see from our investors is really that you'll have a foreign investor. They set up they get their ITIN number, which is like our SSN number. And then what happens is they'll set up an LLC here in the United States, just like we would. They'll get their EIN, they'll get a bank account, the whole 9 yards, and then they can invest through that. Now, how that's structured, if there's anything else that goes with it, really depends because there's a lot different tax laws for foreigners versus people living here or U.S. citizens. So it's something that you have to be very careful. One of the things is that we have I think it's for us, our estate tax is, it doesn't kick into like 10 million or something, right? For foreign investors, it's like 60,000. So
Oh,
it's
wow.
something that, these numbers are, just all averages, you know what I mean? But it shows you exactly how much of a difference that skew is. So it shows that if you are a foreign investor, know that it's going to take months to do. Know that you should work with a professional to get it set up. But once you have your LLC, your bank account, then what happens is now you're just operating as a typical US investor. And that's how we want to work with our investors. We don't take money from foreign countries. We don't take any foreign wires or anything like that. They have to come through a US bank account. And that allows us also to to assist with us, covers our bases in regards to KYC. So know your customer. Because if you have an account with a large bank or any bank, they should be doing their KYC on that person that's opening it, the ultimate, the UBO, the ultimate business owner, beneficial owner, and they should also be doing that. And then when the money comes to us, we know that it's not coming from any kind of shady
Yeah,
activities.
it's
So
verified. Yeah.
yeah, so a couple more steps for syndicators. There's also a tax withholding, which is something that syndicators need to speak to their CPAs about, who's doing maybe not just their personal taxes, but it's going to be handling their syndications, all the K1s. So that's another thing that for the syndicators on their part. So there's a lot of syndicators in the US that don't even want to deal with foreign investors because of all the paperwork. It's something we don't have an issue with. Depending on where you're getting your investors from, what countries they're coming from, as a syndicator, you also have to know if your entity of that you're holding the property in, it has to be different, and the entity that the actual investors are investing into. That's a big thing with Canadian investors, where we didn't have LLCs when treaties were written. So now it's limited partnership. So we make sure that we're not doing LLCs. We're going to be doing limited partnerships so we can bring in those Canadian investors and they're not getting double taxation.
Oh,
So
nice.
these are important things if you're a foreign investor that you really need to work with a syndicator that knows what they're doing. Most of them, I've seen like 50-50 with people that work with them and some people that don't even want to deal with them. And I understand if your whole base here in the United States is here and you have a small percentage, if any, would be foreign investors, it makes sense. But for us, we've built a portion of our business with foreign investors, and it's something that we would focus on.
Yeah, and I know that there are programs out there, and they're kind of like pathways to citizenship to invest into job creating developments, or even just multifamily. It's creating jobs. Then I think there's programs that create pathways to citizenships as well. And I don't know the nuances. There's
Yeah.
a ton of paperwork, like you just said, but it helps. I mean, it helps on both ends.
Yeah.
Um, how do you decide which sponsors and deals and markets to focus on?
So, how our business is situated at this time and how we're structured is that we work with three main sponsors in markets that we work with predominantly, which is Dallas, which is Atlanta, and which is down where I am in Florida, in a couple of markets here between Jacksonville and Tampa. So, it's really the I-4 corridor through Orlando. And how we've done it is working with this way, we allow our investors to have a little bit more, little diversity in their real estate investing. And it gives them the ability to invest in other markets that will kind of cover them if anything happens in one market, which is everybody's always worried about if there's the hurricane, if there's this, if there's that, some sort of natural disaster or something else that happens in an area. And this is one thing that we've kind of done with our investor base, and it allows us to offer deals with people. And it's one thing if you're the group and you're doing deals all these different markets, that becomes difficult because you can't be you just won't be able to become a professional or become an expert on all these different markets. But it's something that if we're focusing on three main areas of the country, three main markets, it's something that when we're working with those sponsors, we're able to really vet them, work with them prior, and then be able to do deals with them. Typically, how we will vet them, if before we're doing any kind of partnership deals where we're bringing investor money into deal, we will invest with them personally ourselves. And then what we will do is, we have a set of roles that we're going to be taking care of, responsibilities at the property, and that allows us to have a little bit more control on what happens and ability to see where funds go, see exactly when we're doing calls. We really like handling a lot of the weekly calls with our property managers, and that allows us the ability to, since we're not really boots on the ground in two of those markets, it's something that we're able to really understand what's going on in the property, while our boots on the ground operator there is able to work a lot with contractors. We're able to work with property managers, and that's everything with going through of what we're setting rents at, move-ins, marketing, the whole nine yards, for keeping the phone really ringing and keeping people coming in that door, and getting those applications in to keep our occupancy high, which is super important to us now.
Nice. That's huge, and that expands your all's reach, and essentially you don't miss out on good deals that pop up, and helps everyone out. That's huge. Um, Give us one of your best experiences, best deals that you've had during your career.
So the best deal I ever did was my first commercial. It was a mixed use property, as I spoke about before. It was my best deal. It was I bought it at the end of '09, and the property had been sitting on the market for. I mean, I think I still have a copy of the listing. It was like 120 plus days, and it was. I mean, I went in there and offered what they wanted to sell it for. What the bank was trying to sell for was like 30% less. And I countered like 1 or 2% higher. And it came up, I purchased it for like literally, I think it was like 26 or 27 cents on the dollar of what it sold for like 2 years before.
Nice.
And did a lot of renovation. It was completely vacant, renovations. And I think it was like 90 to 100 days. I was able to get it. I had multiple crews working on that. And I was able to get it fully rented in it was just over, I think, 3 months.
Nice. That's those are the wins. Base hits win games too. And real estate, it's all there's no size that fits all. If you want to stay with the smaller deals, that's where your comfort is, and whether it's single family or smaller multifamily, then it's just getting in and taking action and doing it. Uh, what avenue would you suggest someone wanting to get into real estate, not really sure which direction? How would you suggest that they move forward?
Yeah, so I love the idea. I mean, when I still drive neighborhoods and I still see smaller multifamily properties, and you want to get involved with them and buy them. It's just really, you have to kind of stay in your lane of where you are, and ours is really dealing with larger ones now. But it's something that if I was going to go back and do the smaller route, I would have focused on more of my properties are all close together. I could have gone into more of a bought more in that area and self-managed them. That's probably what the route, if I was going to do it again today, if I start buying small multifamilies, I would make sure that they were close together as well, with the goal in a couple of years of actually taking those on and self-managing them. People that want to get involved with multifamily investing now, maybe for the first property, I think house hacking is one of the best ways. And it's not the sexiest thing, investment strategy ever. You're living with your tenants, and but it's something that I did for many years, and it was it gives you an insight into becoming a landlord, and it gives you the idea of it on a very easy to manage and small scale. So if you're living in a three family, you rent out the R2 units, you only have two tenants, right? You're next door to them, right? Which is people say it's a con. I believe it's a pro, because if I come back from working or whatever I'm doing and there's an issue in one of the apartments, I'm not driving anywhere. I walk
Yeah.
downstairs, you know what I mean? And you live next to them, but this is multifamily living, so it is. But you learn about it, you learn how to manage people, you learn how to be cordial with people, but also maybe not be friends with them per se. So just all these different moving parts you have that you have to learn when you're in that house hack situation. And really, I mean, there's not too many things that can go wrong in just two units if you're living there. You know what I mean? So you minimize a lot of issues, and you're not going to have units kind of get destroyed while you're there too. So it's the way of becoming a landlord on a very easy basis, with the ability of really an FHA 3.5% down loan. And now if you don't want to do that and you have funds, maybe you buy a larger apartment building. Maybe you buy like an 8, 10, 12 as your first one. If you have another investor you want to work with, maybe you buy a larger one. And then you put property management in place of that, right? And that would probably be the way. It's going to be very difficult when you're buying twos, threes, fours, fives, and not self-manage them. It's not going to pencil. You know what I
Yeah.
mean?
Yeah.
It's
Totally
very
agree.
expensive. Yeah.
It is absolutely. I know both sides, so for sure. Awesome. If you could put a plug in on your podcast real quick, Global Investors Podcast. Tell us a little bit about it.
Yeah, so Global Investors Podcast is my podcast I've been doing since 2019, and it's just based around. We talk about all different real estate investing uh, kind of industries and ways and asset classes, but we really focus mainly. The majority of it is on multifamily assets, and it's about people that want to actively or passively invest in U.S. real estate. So it's like a top 2% podcast, and it'd be great if we had other listeners. You come on, take a look at it, and we do it twice weekly. I do an interview, and then I also do on Saturdays. I call it Strategy Saturday, where it's just a few minutes, and I work through everything from explaining different types of insurances to everything. Anything I'm thinking about, I'll do a podcast episode on it. So we get a lot of people that like listening to those episodes.
Yeah, I like that, and the teaching others and giving information. It helps you retain information too.
Yeah, yeah,
It's a win-win.
yeah.
If somebody wants to reach out, learn more about yourself and your companies, how can they get a hold of you?
Yeah, so everything is on our website. Our website is harborsidepartners.com. So if you go to harborsidepartners.com, there's all the information there. There's going to be our YouTube channel. It's going to be the podcast. We have a free passive investing guide you can sign up for. Tons of free resources and information. If you're interested in actually passively investing into a deal, not a problem. You can fill out one of the forms on there. And you can speak to one of us, one of the partners here. And then if you're interested in actively investing in real estate, we have a section that you can go to. We call it Syndication Superstars, and we talk to people about buying their first property to getting into syndication wherever you are in your journey.
Nice, very cool, awesome, Charles. I appreciate your time. Definitely look forward to following you and watching you all grow. And we'll talk soon.
Thanks a lot, Josh.
Thank you.